Rob's Child with Chapter 15 of Security Analysis. Nothing I say is investment advice, and I'm here to open a discussion about the book, not replace it. So, Chapter 15, like we talked about last time, this is all about preferred shares. It seems like he's still pretty much against the idea generally, but basically has a few preferred shares cases where it could work as a fixed value investment. Overall, I think he's still against the idea generally, but so let's dive right into it. The main thing here, I think we talked about this in the last chapter too, is just that there needs to be even a higher safety margin than what you would need for bonds, because bond payments are obligations and payments to preferred shareholders are not so much. And he says something funny in here. We might seem too stringent on, this whole matter that, but again, you have the, if you think the company is going to do really, really well, why would you own the preferred shares? Just own the regular shares. And if you want a secure return, why would you buy preferred shares? Why not just buy a bond? But anyway, so we go into a few specifics. Again, it has to be super safe. So one thing that could possibly make preferred shares a little bit more attractive is if it has no debt. I don't know if there are. I don't know if I've looked at a balance sheet of a company that had zero debt, but maybe they do exist. I don't know about them, or they have existed in the past. He seems to talk about that and how that could be an attractive situation, so that all the earnings, as long as it's making earnings, the first payments are going to go to the preferred shares, and assumably you'll have some left over for the common shares too. This is kind of my assumption on that idea, but he also adds to that. He adds stipulations to everything. He's like, yeah, I say this, but then there's this. So he says, that obviously this does not exclude necessarily preferred shares that also have bonded debt. And he mentions again with tricky accounting practices, apparently people in this period were advertising various securities in ways that were not entirely honest, I guess is the best way to put it. Something important here on page 202, it explains if you had trouble understanding at any point before what he calls stock value ratio. Is that correct? Stock value ratio. Page 202 explains it all. If you try to Google this concept, it takes a while to figure out what he's saying. I tried looking this up on ChatGPT, like, what is this thing again? 202 explains it pretty well. It's just how market cap, you just got to read the page, but it's how the market cap of the company relates to the total amount of debt. And if the total market cap is bigger than the total amount of debt, that's, more of a positive thing, where, and the greater the stock is worth, the more secure, the company seems, the safer the company seems, basically. But he goes into all these details regarding that. Yes, and then we go into how preferred shares that are cumulative are better than non-cumulative. And I believe before this point we weren't even talking about cumulative preferred shares. And I guess these, there's a court case he mentioned about this too, about how non-cumulative shares somehow became cumulative shares by order of the law. But then, I don't know, it's a little bit messy. Point is, at some point, people figured out that cumulative shares was a more appropriate way to have preferred shares in the first place, which just means that you're owed past payments that were missed, sort of. Like, that cap on the amount that you can get, it's not, let's say, a 6% it's not just for that 1 year. If you didn't get it 1 year, then you still can collect that from previous years, kind of a thing. And then, yeah, and I think that would take precedence over paying out to the common stockholders. So when there's a bunch of leftover earnings, you finally get paid. So that cumulative aspect is pretty important. And he goes into that quite a bit. So we get to the end of the chapter, and he goes through all the preferred shares that have existed and how good they are, especially regarding non-cumulative shares. And the conclusion at the end of the chapter to me seems to be that the snuff business, SNUFF, which is chewing tobacco essentially, is the safest place to invest money. It seems like that's the final conclusion of this chapter. And, I gotta say, I personally own some stocks, common stock of some high dividend tobacco companies, Altaria and British Tobacco. And he basically was going on how like it's recession proof. I mean, think about it. I don't know if they knew how addictive nicotine was at this time, actually, but like from a perspective today, like we know how addictive it is. It's just sort of a sin stock, and it's kind of funny. He pokes fun at the fact, like, I'm gonna quote this: a strong reminder regarding this. I quote, "Strong reminder it offers that the investor cannot safely judge the merits or demerits of a security by his personal reaction to the kind of business in which it is engaged." And so that's a long about way of saying, sin stocks, and this goes to Burry buying a prison for profit stocks. I also own a little bit of GEO currently right now, GEO, but so snuff stocks. And I see personally, again, that is a pretty good place to be, especially considering the risks going forward. I mean, when people are choosing what they're going to be buying, what they're not going to be buying, tobacco, it's not the it's a sin stock, it's like you kind of are like, do I really want to own this? But at the same time, look, if people want it, people want to enjoy it. Why not take advantage of that? I mean, I don't know if I sound evil saying that, but it's an area you can invest in that I think is very much recession proof. And I like, being invested in that area personally. But anyway, I think that covers this chapter for the most part. And so I'll see you next time for chapter 16. I hope you enjoyed the episode. Please comment and discuss in the comment section below. And see you next time, Rob's Child.